TGIF Warriors. Go ahead, Blake.
Well, good morning, Dale. How you doing today? TGIF to you.
Yes, buddy, we made it.
We did that, and I'm quite happy we're here. So starting today, I just want to make sure everybody knows this that's here. You know the old saying, Dale, early bird gets the worm, right? So all of you guys and gals that are here early,
Not with
because
a bottle of tequila.
no,
The
oh
the last
shoot.
guy, the last guy gets the worm.
Uh, all right. Well, I was just gonna say, hey, you guys are the first to know that you get a shot of tequila, and we have our summer sale that's on right now. So come it is 40% off, and we are doing this for the next couple weeks. The Liberation offer was a huge it was huge for a lot of people because they're like, oh my God, that's the cheapest you've ever, brought down your prices. So we're doing that again, and you guys are all the first to know. So with that being said, Dale, I'm going to pass it back over to you.
Okay, Blake, take advantage of it. You know, uh, just more generosity from the team.
We're
So,
fighting inflation, baby.
yeah, it's the only thing that prices are going down on. So, let's take a look. Before we get to the markets, Blake, I just want to talk about one thing that the media is not really paying much attention to, except reporting that it happened. Yeah, I'm not going to get into Bible prophecy or anything about Damascus being bombed. Okay. Ezekiel talked about it being destroyed. But on a practical side, Erdogan was behind the group that overthrew Assad and is in control right now. And let's face it, Turkey's economy is in shambles. It should be a lesson to all governments that are considering letting their central bank be controlled by the president or the leader or the dictator that he definitely destroyed the lira over a course of years. So there's no love lost for Israel. Turkey calls it a terror state. You could agree with it or not. But this has the potential, if Israel does go ahead and keeps attacking Damascus, to widen this regional war. Erdogan could use a distraction right now besides arresting mayors across the country. He's been putting his political opponents in jail. I don't know how much bread costs for the average Turk right now. Probably be equivalent to us paying, $10, $15 for a loaf of bread. And when things like that happen economically, a dictator's playbook is to get involved in some type of conflict because that in general unites the people even during times of crisis. And what really complicates it is Turkey is a NATO member. So just something to keep in the back of your mind that this, may not happen right away, may, happen in the fall, but it's a big deal. Actually, Damascus is the oldest city on Earth. Okay, so anyway, I want to talk about that. You guys know, I'm interested in geopolitics, and that was one of the reasons that I was forecasting that there would be an attack on Iran, and why I was long energy going into it. I don't see any trades related to that, but I just can imagine what would happen to the gold market should um, the war expand with a NATO member involved. So now let's get to the market. So euro, what always bothered me about this euro being at top was, first of all, it's grinding sideways action. It held where it had to, and more than anything else was that at the highs we had RSI confirm it, as you can see up there. So it was not a divergent high at all. And now, should it be able to generate enough power to take out that high, it will diverge on a daily basis, even if we went, I think, to, 119, 120. I don't think it's going to blow out the divergence, especially if it happens quickly. And also what I talked about yesterday around the close is this is a very important area in the Dixie. If it takes it out, we had 2 days where it held this. We had these pins here on the candle. This was the first inflation report, and then this was the rumor about Powell. So we take out 97.20. That's going to change the picture, I think, and open the door for new lows in the dollar. So if you're long the dollar, you don't want to see this 97.30-20 area taken out. I do because, I'm long some euro. I booked half, and I think that there's a chance for us to make that move to new highs or at least get a pretty good failing rally. So now I'm going to turn to Ryan. I know that you're thirsty. Even though, what time is it over there? Beer time or already? What time is it?
It's always beer time over here.
Yeah, you ever have a breakfast beer on the weekend?
I have a breakfast beer if I'm going abroad somewhere, say for a football match or something.
All right.
There's nothing like a 6 a.m. pint in the airport.
All right, buddy. So here we are. We're still lower on the week. These lows are important in euro, and let me show you why. If you don't use your telescope, you'll never know. But you guys, over the weekend and occasionally during the week, take a look at your weekly. So, yeah, so look at the 9-week moving average, how it held the decline so far. Underneath it, look at all the air. There's a lot of air underneath it. So the lows we put in yesterday are critical. It could still be a 2-week reversal because it probably will close under 1774. So on a weekly basis, it's actually a sell signal that I'm going to ignore and carry this into next week. But where are you at on euro now that it held your level? You came up with that level at 15.5 yesterday, Ryan.
Yeah. Well, before you, well, you've done it now. I was going to say before you flick it over, it's always important that traders, Monday, Sunday night, Monday morning, you always have a look around all your time frames. You get an idea because a lot of traders get sucked into the short term. You look at that chart, at least since the start of the year, it's been one-way traffic, and this move off of 118, it's a minor pullback. It's not even at the 38.2 of the last leg. Couldn't even get there. So yeah, that's one thing. Shorter term, yeah, it's held a level. It wasn't it wasn't a do or die level that it held at 115.70. It just came off a prior high, and we'd had previous support there. But that's where it chose to hold. And so the fact it's held makes it more of a marker now. Can we go back all the way back up to 118? Go and test 120s? We could do, but I'm not sure that the same reasons that got us up there are still in play, i.e. exiting out of US assets, because as we've seen again this week, the data's holding up. And so, that's put the brakes on. So I probably would expect for now, maybe to set up a bit of a consolidation range, maybe something like 115, 117, with the odd extension perhaps.
Okay, so Ryan's point is that S&Ps have made new highs a couple times this week, while the DAX hasn't. Is that correct? That some of the foreign markets are not leading the way they were several weeks ago?
Yeah, a little bit. We've got, again, for Europe, you're talking things like the DAX, which has been an absolute ripper, even while the economy has been, stumbling along. We're getting into budget territory now. We got the EU budget, which Germany's against. That's the biggest fly in the ointment. So we're now starting to deal with the fiscal picture in the EU, and everyone remembers, oh yeah, we've been buying the euro, but let's remember what's going on in Europe. But the DAX is within touching distance of its all-time highs, so it's not exactly falling out of bed.
Right. Okay. And Cable, you guys really pointed out how it was holding so well, you and Blake yesterday and Kman, and looks like we're going to try to come out of the hole. So I was thinking, even if the euro does make a new high, that maybe all you get here is some type of fib retracement, maybe back to 36. Look left. This was a big area here up at 136, and we get up there, it could look like a massive head and shoulders top with the neckline here that could
Knew you
take
was going to
it
say
on.
that.
What's that? Yeah.
Knew you was
All
going to
right.
say that.
All right. Well, I'm an easy mark. I'm
But
very predictable.
but no, you've got a good eye as always, Dale.
Yeah.
And if I always, when looking at those sort of things, I'll be thinking about selling the shoulder, let alone waiting for the neckline to break. So
Yeah.
if you get up to that 136, what is it, 20s, something like that,
Yeah.
and it's
Yeah.
holding,
Yeah.
then yeah, that would be probably your key to give shorts a little go.
And then just one other thing, when you look at, and we talk weeklies, if you're real brave, you'll even look at your monthlies. Yeah, they really, how
Should
about
do.
this? Yeah, I mean, I know that we have measured moves towards 120, and I hadn't looked at a monthly for a while on euro, but what a coincidence. Look at that 200-week moving average right at 120.
Yeah,
So there's some confluence there.
yeah.
So look at your
I think
monthlies. Go
I
ahead.
think you're probably the only American who actually goes higher than a 5-minute chart, Dale.
Yeah, well, yeah. Well, it's because of my life. There really wasn't a lot of immediate gratification. I usually had to, put in a lot of attempts to break through on different levels in my life. So
Yeah,
persistence and I believe that you have to have the big picture in mind, even if you're a day trader. So
always.
yeah. So just one last thing, and then I'm going to go to K-Man. I looked at, we've had this bottom in the dollar from that 96 level. But you know, look at the difference. Now, this was a move, okay? There's your daily on the end. This was a pretty powerful move from 43 in a week and a half, 2 weeks. This was a pretty powerful move until today. But the dollar, look at that. It's nothing.
Yeah,
I mean, it was really nothing. And, we get excited because it's, finally moving counter trend. But I look at this and I think, that we have drive one, we have drive two, and now I think drive three is going to come in. We take out this 97 and change level. We could get to what were really Elliott wave targets, Grega targets, C equaling A from the 114 high down around 95. So that's kind of what I'm thinking. And the thing that bothered me about the euro, about the dollar, just like the euro, was this. It bottomed on a confirmed low. So it bothered me a little early. I got out last week at 97.30, left 100 on the table, but caught some other things. But pay attention to this level. If we take it out, maybe we don't get a dollar low until late July, early August. So just
yeah.
something to keep an eye on.
A bit of moving average confluence coming up as well.
Yeah, right here. And
Yeah,
there it may try and hold a fib. I think 97 is going to be around 61.8 back of this move to, at
and
worst 90s.
the
Go ahead.
38.2 is probably around. I think that green moving average, just
Okay.
eyeballing it.
7.5 about.
Yeah, give or take.
Okay.
So you got a
Okay.
bit of confidence there as well.
Okay. Anything else you want to share before I go to K?
No, go ahead, mate.
Okay. Good morning, K-Man. How are you?
Did you just call me caveman?
Yeah, you're right. You could get a roll on the Geico commercials.
That's what I heard too.
Yeah.
All right, well,
Morning,
caveman.
Dale. Morning, everybody.
Good morning. Let me ask you this. When you met your wife,
Yeah.
caveman, did you hit her over the head and drag her back to your cave by her hair?
No, I wouldn't dare, mate.
Okay, all right.
I think it's the other way round, mate.
I wouldn't dare. No, I'm a gentleman. I'm a
Uh,
gentleman.
all right. You're not a caveman.
I just don't reply to the phone. I just don't reply to the phone when she calls me at the pub to come home.
That's tough enough. Anyway, most American men wouldn't do that. They'd be afraid to go home. So you're brave. So is there anything you're doing in here as we wrap up the week? What's your biggest takeaway here? Here, okay, okay,
Well, I'm
man.
just very tiny short. Just very tiny short yen, the currency, because I after a non-event Besen Ishiba and Besen Takazawa, we are going into the elections, but it's nothing that's going to break my account. No, actually, and I realize I didn't even call it in the room. I'm just jobbing gold from the long side. This a bit of wicked risk, I think, with all those things that well, US sending weapons, but then also the packet US 18th package on Russia, naming even a couple of Chinese banks. There's always a bit of weekend risk coming up.
Okay.
Um, for the rest, I have not really done much. No,
Maybe
I
we
haven't
get,
really done much.
maybe do you have targets up around 3,400 or are you looking for new
Yeah, I
highs on
mean,
gold?
well, first of all, we have to get above that 33 three quarters. But yeah, the rest,
Yeah.
the next one is 34 figure 10 for me.
Okay.
That's where I'll gladly reduce anything I might have that time. Well, what I did actually, and I know there's a couple of people in here won't like me, but I started to sell, but it's only a first entry. Started to sell dollar Mex again. Yeah, I think we could have gone higher on that retracement, and stopping in those
Yeah.
1880s doesn't really tell
It
me that
only
it's
had
going to
one good
fly
day.
anywhere further. Sorry?
Yeah, it only had one good day. Everything else was chop,
Yeah,
right?
there's a lot of
This
chop.
could,
There's still a lot
yeah,
of chop going around. I'm not saying this
yeah.
thing is going to break 1850 next, but I'm just not mad. I'm just not overly impressed. I still think there's a lot of like short covering going on instead of like people really thinking Mexican peso should go down. But for the rest, we are zooming into the weekend. I really think the big thing we are waiting for is those Japanese elections, and been talking a lot about it on Flow Show in our room. And just one thing, and people, well, the big question will be whether Ishiba and the LDP together with Komeito lose their majority, right? Which is extremely
Yeah.
fragile. But there is a bit of a kicker there, I think. That's the CDP because that's run by Noda, and one has to know that Noda was prime minister during the big quake in 2011. He's
Yeah.
got a lot of justified critic over his head by how badly they run everything, but is the Japanese ready to forgive after 15 years or 14 years? That's going to remain the question because if they don't, that may actually open the door to keep some really slight majority. But if they do, they that could tip the scale really, and make Ishiba lose his majority. So I'd say it's a bit like when you look at the jobs report, you look at the headline number, and then you look at the uh, the subcomponents. Here for this election, I think it's we need to look at what the CDP is doing as well, because they may come out and potentially rally a few more of the opposition parties around them to really go and block the whole thing. In which case, it's going to be a real mess when we wake up on Monday.
Yeah. When you look at this as well, um, it does look like some type of topping formation where symmetry
Yeah,
would come in here. I mean, now look at where the 200 week is coming in
yeah,
at the breakdown level.
yeah. I'm not sure that this election is going to be enough to bring it down there. It's
Okay.
going to take a turn in the dollar
Yeah.
for good. And yeah, the the impact of the election on its own to the downside, maybe 100, 150, 200 pips or so, but I'd be more worried about the top side still if they lose their majority, because the problem is not only losing the majority and being a mess in Japan, but what's going to happen to the trade talks with the US. And because some of those other parties are perhaps some of them are real hardliners there. One of them has already been asking for a reduction in all the tourists into Japan because they're driving the prices up. So I don't
Wow.
know. Yeah.
Yeah. Well, maybe you get some type of ABC and then we're off again. So far a failing rally. Not much of a failing rally, but I don't know. I have no position here in yen now because when I was bullish, I was talking 150, and we almost got there. So I don't know what to do with that either. Anything else top of mind for you going into the
Yeah,
weekend?
yeah. Cable yesterday, remember we spoke
Yeah,
about it, 133 three quarters.
you sure did.
It's a bit of a magic level there, and
Yeah,
even through the numbers yesterday, which were better than expected, the retail sales, we still held the level.
yeah,
It's a really important one, and it's already moved quite a bit away from it. But yeah, that's a pretty decent level. And then on the top side here, I've got some reasonable stuff going on, just 135 and above. I agree with Ryan in the on the potential range that we may be forming. We may have seen an intermediate top in the dollar, and now we are going to try and find where the bottom lies. And yeah, could be 135 in the cable, around
yeah,
117 in the euro, things like that. It's yeah. I'm
yeah,
not sure that this is now we have done the correction. But if you start to break those levels, then this correction in the dollar may just be over.
yeah. Aussie. I know people are more bearish now after we took out these lows, but couldn't this just be an ABC, Blake, and then we blow off one more time in Aussie?
Yeah, I mean it's possible that we just hit the 618. I thought that the double top was gonna weigh on the Aussie a bit more. And we remember this we had a sell-off following the Aussie data. So that's what actually took it lower. Here, I'll show you guys what I'm talking
Okay.
about. The problem that the Aussie had is that it really, you can see it right here. Let me get rid of this. So we had a double top. It started to break down through the neckline, but we hit the
Oh,
618
yeah,
and then really bounced from there.
yeah,
So that right there is my opinion was what caused that. But it's not just the Aussie, obviously. The Aussie is just respecting what's happening with the dollar, and you can see that the euro, as you guys were just talking about, it's held some pretty key support. And I want to say that the dollar correction could be over. A lot of this has to do with this risk that is associated as we come through this weekend. I mean, you're coming into the weekend, you've got an unhinged Donald Trump, and it's the same topic that was the week ahead video last week. I said, politics and the markets, they don't mix. And right now, Trump is feeling pressure. He has erratic behavior. He can be more erratic over the weekend just to try to, get the attention off this Epstein file case that's really it's his Achilles heel right now. you know, that could be, you know, the attention could be turned right back on Powell. And who wants the dollar risk going into this weekend?
Can I just say one thing that would kind of amaze me? You know how, he's the talk about firing Paul, but I actually did see an interview where he was lamenting the same things, too late, kind of a lousy Fed chairman. And he actually said, I don't know how he got appointed.
I know. You were like, come on, dude, you appointed him.
I mean, I don't know how he got appointed.
I
That's
think,
just
you
mind
know,
blowing to me.
well, okay, so you know, I know I don't want to. I'm going to say this, and it's
Yeah.
probably going to tick a lot of people off. Trump says a lot of things, and I think he says a lot of things just to appease whoever he's talking to at that moment. And so
Okay.
he gets mixed up in his, you know, his own comments, and I think things get it mixed up in his head. So yeah, I saw the exact same interview. I'm like, wait a second, you appointed him in 2017. like Powell
Yeah.
is your man, you know, and but I know he harassed him. You know, during the, you know, COVID situation and everything else. So, you know, I mean, that's not new. But anyway, regardless, yes, he did appoint him, but I do think he's really going to be under fire. And so I don't think that's changed. Anyway, with that being said, I think you're seeing people reduce dollar exposure going into the weekend. And I think right now you just have to focus on, if you're talking about the euro, you just have to focus on this 115.70 level, 115.60 level. This is critical. Here, let me get rid of this trend line here. This is just it's simply a previous high that's held as support, and that is going to be your level. We just finished bouncing to the 618 retracement just now. If you're in the Forex Analytics chat room, we've been talking about it all morning long. So and I, you know, just made sure that I updated you there that that has happened, that the euro is approaching the 618. We've been, you know, talking about it this morning. And so, you guys already knew it was coming. We are there, and we just hit it and basically reversed. So if you're chasing the euro higher right now, you just realize you just bought it right into a key golden fib level too. We still have data today. We still have, as you guys have been talking about, we've got, you know, the Japanese election. I know, Kman, you expect the risk is further yen weakness. You know, if the LDP doesn't get a majority, and you know, you got people that are looking for 400 pip moves, you know, if that is truly the case, which, you know, I think that's a
Sure.
little exaggerated, but who knows, you know. I'm sorry, you were going to say something.
No, I said sure.
Yeah, yeah, I
No, but I'm
mean,
thinking, no, look, there's been a lot of yen selling already done, right?
right, I mean,
Or
that's, you've been pointing it out
or
for the last week and a half. I mean, for Christ's sake.
yeah, for even longer, and even from when it started on to be uncertain about the trade deal, and then people started to think about the elections, and we know what the risk is. So I think ahead of the weekend we may actually see a bit of people reducing actually a few positions, but then you look at the dollar is one thing, but then look at those yen crosses, how high they are. So yen has not been only sold versus the dollar, but it's been sold versus virtually everything.
Yep.
So maybe the positions are loaded, and we are going to see a bit of pre-weekend hedging. But the the issue I see that if Shiba really loses his majority is the mess that it's going to create, and then traders will really chew the bone, and I really think there is a risk for next week. So we've been talking in length about it on the Flow Show as well. I do think that there's the two, Bank of Japan and MOF, will be online. Obviously, they will be ready to do whatever is needed. So we are going to need to have to watch two things: is the Japanese bond market, because the Bank of Japan could decide, if there is stress in the bond market, to do unscheduled bond buying to try and calm the nerves there. But then the other one is the spot FX. if really we open like around 150 and then rally really quickly to 151 and that infamous 152 again, then maybe the MOF may feel it necessary to come in, because remember what Kuroda always said, that if we have like several sessions, he said, but if we have like 200-300 pips move consecutively, that is excessive and speculative. So we are going to have to not only watch the direction of things, but also the amplitude of everything going into those elections, or when the results will come in. But I still think the risk is, if people talk about several big figures, it all going to depend on what kind of majority, if he gets one, he still have. Because if it's like literally 124 seats out of 248, it's still going to be a mess, right? And then I'd see maybe a bit of relief rally in the yen, and but afterwards the market may start to sell the Japanese currency again.
Okay, thank you, Kman. Really, I'm sorry, Jim. I don't mean for us to and Dale to bleed into your interview. There are a few things that I still wanted to mention for the last few minutes here. Bitcoin has stalled at the 618 retracement. You know, this is one of those situations where we've seen this massive move in Ethereum, and Bitcoin is now starting to stall. So just keep that in mind, that we've knocked our head up against some pretty critical resistance. One other thing I wanted to point out is gold has held major trend line support this week, this entire week. And that, right there is what's going to really be a deciding factor on what I want to do with currencies, is really what happens with gold, whether we have a resumption of an uptrend or we see a reversal of this major trend line. Guys, I want to say have a great weekend. Don't forget, especially I want to mention this. We have brought back our summer sale, or we have brought in our summer sale. It is 40% off month to month. If you missed the Liberation offer, this is your opportunity to get our discounted price. We've never discounted it up until the Liberation offer. So a couple months ago, 40% off month to month. Since it's we had a lot of people clamoring about that they missed it. Well, we're gonna open it back up for at least a couple more weeks. So take advantage of that pricing. I know that once you're in and you're grandfathered in, your prices don't go up. So this is our way of fighting inflationary pressures ourselves. So Dale, have a great interview with Jim. Ryan, Kman, thank you guys so much. Have a great weekend.
Cheers,
and
mate.
we'll catch you on Monday. And Jim Welsh, weren't you wearing the same shirt yesterday when I met with you?
No, I made sure I wore a different one, but I did get a haircut. So
hey, looking
I'm
good,
even better
buddy.
looking now.
Both of you guys are looking good. I'm going to turn it over to you two.
We used to be young.
There's a lot of that going around.
Yeah. So anyway, thank you, Ryan. Came in another great week. Blake, Dream Team, Grega, the whole team. Thanks for laying it all out on the court.
Yes,
okay, but have a great weekend, guys, and we'll do it all again. So, Jim, haven't talked to you in a while, but we know each other so well. I could probably ask you a question. What's my favorite fib extension?
1.618.
So that's what happens when
Was that a lucky guess?
That's what happens when you talk to someone for 30, 40 years. We met before there was a CNBC, and we were both on an LA channel called KY, and met at a bar in Carlsbad and got to know each other. And we used to talk markets every day, and I started bugging Jim again, and I'm calling him. And Jim, I thought a good idea before we get to the markets is, I know a lot of people are familiar with you from Trader Summit and the weekly interviews you do with Blake, but I'm sure there's some new people that are watching live off X today and in our room. And how do you feel about offering a complimentary issue of your newsletter?
Absolutely thrilled to be offering a complimentary issue. Just send an email, Jim Welsh Macro at Gmail, and I'll send you either a weekly technical review or an issue of the macro tide, which goes out every month.
Yeah.
Let me interject real quick as an overview, Dale, and it's great to be joining you. I basically approach the markets, I would say, with a three prong basis, and that is looking at the fundamental side of the equation, technical analysis, and then looking at sentiment and positioning and the concept of contrary opinion. And those three things, when they're combined, has helped me have greater conviction at various points in the market, turning points, and so forth. And I just think that that's important. And technical analysis is good, but sometimes these other aspects can really provide, more of a top-down viewpoint and hopefully illuminate the bigger picture so that you can see the forest from the trees.
Yeah, yeah. I mean, you actually gained your reputation from being a Fed watcher and writing about monetary policy. I think that, in fact, your newsletter back then had a title that was related to it. What's the name of it again?
Right now it's
Before,
macro ties, but way, way,
right.
way back when it was the financial commentator.
Okay. So, Jim really pays attention to the Fed, pays attention to what the streets narratives are, and sees when there are, conflicted or out of line type of narratives. So let's get to the markets now, Jim.
Yeah.
I've been talking to you and, people up until the 10-year bottom at 420 and started to move to the upside were pretty sanguine about rates were going to come down. And since that last employment report, the opposite has happened, and a lot of people were wrong-footed, looking for lower yields, and we're getting higher yields. Is this a major reason that they're starting
Well,
to?
it's a combination of things, Dale, as it often is.
Okay,
The labor market remaining firm. I think expectations that inflation is going to be ticking higher. And as long as the economy is on decent footing, as it has been, the Fed doesn't have any reason to move forward with rate cuts. Their bias, I think, is to cut. But they also believe that tariffs are going to cause inflation. A survey by the Atlanta Fed back in April found that almost 50% of companies were planning on passing the tariff costs that they're going to incur on imports along to customers. The willingness to raise prices is much greater today than it was, 5, 6, 7 years ago when companies were worried about retaining market share. And consumers too. I mean, if somebody raised prices 6 years ago, consumers took notice very quickly. And today we have all been kind of conditioned, well, it's up again, and we're resigned to it. So the key here is companies bought a lot of stuff before the tariffs went into effect, and we've been working off those inventories, which is why we didn't see evidence of tariff inflation in March and May in various inflation reports. But the one in June, there's some aspects that are starting to show up in goods, core goods prices is one of them. And so you can see in the month of June, the pop that happened that month, more importantly, Dale, the 12-month moving average of changes turned positive. So you had from late 23 until this last month,
yeah.
goods were actually deflating, which helped offset some of the service inflation. So the combination of goods prices coming down, energy prices coming down, contributed a lot to bringing inflation down. This is one of the first signs that, okay, we're starting to see a bleed through. Yesterday, the import price indices showed the same thing. On goods, it was up 0.4%. So we're starting to see more, if you will, the bleed through effect. And the other thing to remember is at the beginning of this year, the effective tax rate was 2.3%. It's somewhere between 13 and 15. I don't think Trump's bringing it down below 10. So companies either have to eat the tariffs they're paying, which is going to hurt profit margins, or they're going to pass it along. It'll be a combination of those things, Dale. But I think this is why the Fed feels they have to wait just to see the magnitude of inflation. And my take is we'll see the core CPI above 3%. The headline will probably also go above 3% in coming months. So it's very difficult for the Fed to cut rates in the face of that kind of inflation news. So those are all the
Any
background reasons.
chance, any remote chance I know it would create a firestorm for the Fed to raise rates.
I really think the probability of that is very low. And the main reason is that the current level of the funds rate is somewhat restrictive. So
Okay.
policy based on rates, in other words, the difference between where the funds rate is at 437 and all these different inflation measures is relatively restrictive. So I don't think that's likely, Dale. I think
Okay.
all of Trump's comments and berating Powell is working against him because the Fed values its independence. And as he berates Powell and the Fed, they're feeling, I believe, they're going to need more justification to cut rates had he said nothing, or if he had said, you know what, they'll do the right thing when the time comes. Because if the data comes in, kind of mixed, where well, they don't want to cut rates at that point in time because people will say, oh, hey, Trump worked his magic, they're cutting rates. So I think he's hurting his own cause by doing some of the stuff he's doing because I don't believe he's going to he will fire Jay Powell.
Well, I mean, I was talking about this morning, Jim, that if you don't believe the independence of the Fed is important, take a look at Turkey. With
Yeah,
Erdogan directing monetary policy, their currency has been decimated 90%. Their economy's in shambles, and all of the monetary policy came from Erdogan.
yeah, right. No, now again, is the Fed is criticism of the Fed warranted? Absolutely. I mean, about one third of the time they're right. In other words, they believe in the concept forward guidance. That markets will be less volatile if the Fed telegraphs what's coming. But the problem is the Fed is wrong about two-thirds of the time of what they think inflation is going to do, the economy is going to do, and even the funds rate, which they control. And we could have a lengthy conversation about that aspect. So I'm not defending the Fed, but to your point, independence by the central bank is a critical feature. And when you lose it, it's very difficult to get it back.
Yeah, so be careful what you wish for with President Trump having a greater say with appointing his Fed chairman, which is also Powell, as we talked about this morning. That
Yeah, no, he's
he,
going to appoint somebody who would be more friendly to cutting rates and maybe making other changes. But every month or every meeting, there's 12 people that vote. And so the Fed chair, does he have more influence? Absolutely. But he's one of 12. And you've got 7 Fed governors, and Trump will be able to appoint a new one come January because their term is up. But you have 5 rotating presidents. Well, I should say 4 because the New York Fed always votes. So my point is, I just think he's opening up a can of worms, and I don't see where there's real benefits of doing what he's doing. The other thing I'll point out is last year when the Fed cut the funds rate by 100 basis points,
yeah, yields went
last
up.
September the 10-year was at 360. Where is it today?
I've
You
never
know,
seen anything like that in my career, Jim. I was baffled by that move.
You're right. Now, I can say, during conversations with Blake, I was looking for yields to go up back last fall, just based on the chart pattern and other aspects. But my point is, just lowering the funds rate isn't going to
Solve
automatically
anything. Yeah.
bring long rates down. And mortgage rates aren't tied to the funds rate; they're tied to the 10-year. So again, if you denigrate the Fed's position by appointing a lackey, there's some negative side effects to that.
Okay. So let's talk about this wall of debt and the rolling of debt that's coming due. Would you say that most of the debt that's coming due this year was financed close to zero interest rates so that even if they refi at 4, that it's a huge increase and may make it, the government make it even more difficult for them to first sell it, all
Yeah.
the supply, and so much more expensive than it was.
Yeah. Well, we're going to have a graphic in a couple slides that is going to show the composition of Fed debt, and about 22% is T-bills. So that aspect doesn't change, but you're right. Paper that was issued back in 20 and 21 and so forth.
Yeah.
That stuff that's rolling over, notes,
Yeah.
treasury notes that mature between 2 and 10 years, that definitely is going to lift the cost, as well as the 10 and 30-year bonds. The average maturity is 7 years. So if you go back 7 years, you're talking 2018. But the trend as this paper comes due, if we can go to the next slide, Dale, that'd be good.
Sure.
The average cost of interest is going to go up in coming years. And this is what I wanted to do, is kind of go through, well, why is Trump, pushing so hard? And it's to the point that you're raising, is that as debt comes due and then is reissued at the current levels, that is just going to cost the Treasury more. I think this year the Treasury will spend over $1 trillion on interest expense. So by bringing the funds rate down and hopefully bringing the curve down, that's going to save the government and the country a lot of interest expense. So this is why Trump is pushing so hard. And hopefully you can find that next slide.
Okay. You're pushing too hard. You're pushing too hard on me. Too hard. Remember that one?
I'm trying to remember.
Maybe it's my singing.
No.
Okay, here you go, brother. So
Yeah.
Okay, a little too big. There you go. You see it?
No, I don't. I still see core goods.
Okay. I have to reshare it then.
So, we're going to go through these chart slides just for the deference of time. But the idea being that, that's the last one. So what basically, as I said before, I think 22% of the debt outstanding is under 1 year maturity, 52% is between 2 and 10, and about 17% is 10 and extended. So, the interest expense thing is why Trump is pushing so hard. And, talking about cutting the funds rate by 300 basis points, obviously, that's just not going to happen unless, we're headed toward a deeper recession. And, that's not the case. Why don't you go back to the one you have, Dale, just so that we'll pop along here real quick, because that chart you put up just a minute ago shows the funds rate versus, I think 3 sets of inflation metrics. You have the CPI, both the headline and the core, the PCE, headline and core. They might have had the PP in there, PPI.
Yeah, I'm sorry, Jim. I never used a zip file before, so I've just been winging it. But so I'm going to have trouble bringing them.
Okay.
I am having trouble.
Yeah.
So
okay. Well, the point being is that inflation really took off in 2021, and Powell and company kept saying it was transitory. Back in June of 21, I was writing inflation wasn't going to be transitory. And by the summer of 2021, Dale, all these inflation metrics were moving rapidly to the upside, and they were between 4 and 5%. Now we see the funds rate at 4.37. Most of the inflation metrics are between 2.5 and 3. That's where the real funds rate comes in. But that chart, and if somebody wants to see these charts, I'll be happy to ship them along to you, so that if you re-listen to Dale and my segment, you can kind of look at the charts, to kind of give you the visual that you need. Again, this is why Trump is pushing so hard. It also shows how badly the Fed mistake-wise did back in 21 and 22. And then I think part of that is a leftover, Dale, the reluctance of cutting rates in the face of what's going to be higher inflation, I think is in part because of what happened in 2021 and 22, where they fell so far behind. They don't want to make that mistake again by cutting rates at a time when inflation is starting to rise. The other thing that the Fed puts great weight on is inflation expectations. You'll hear the various FOMC members giving speeches about inflation expectations, and their belief is that if people experience inflation, they're going to then incorporate that into how they live and how they approach when they go to the store, well, I better buy more because, gee, in 6 months it's going to be more expensive. I think they overweight it, but I'm just telling you what their mentality is. And their concern is if we get another bounce of inflation from the tariffs, that, the inflation expectations will become more unmoored, and that will only complicate their job.
Okay, so is this what you would say to people that are speaking the narrative of the Fed being way behind the curve on this, that they should have been cutting? How do you answer these people that, and even President Trump about too late, Paul?
Yeah. Well, the Fed is always too late. They're driving the car looking through the rearview mirror. The data
Okay.
we receive is at least 30 days old in most reports, sometimes up to 60 days. So, by nature, they're going to be a little bit behind the curve, and they usually are. At the same time, President Trump with the tariffs has created a legitimate reason, and the fact that the economy continues to chug along. I think the Atlanta Fed is at 2.6 for the third quarter. So, again, they've got reasons why they are doing it. And as long as the unemployment rate at 4.1, if you look at a 50-year chart of the unemployment rate, being in the low fours is rare. And if we're removing some of the labor supply through deportations at the edges, that tightens the labor market. So again, I think the Fed, from an academic standpoint, has a reason. And the thing I will point out, in the last press conference, Powell said, if it wasn't for the tariffs,
Right.
we would likely be cutting rates.
Right. Yeah.
So, it's a set of circumstances, and President Trump has contributed in part to that.
Okay, so we have about 10 minutes left.
Yeah.
So this is an example of how Jim really has a grip on the fundamentals, and you learn a lot by reading his stuff, unless you are a student of this. To me, without a chart, I'm blind. Okay, so why don't we talk about some actionable things that you're thinking
Yeah.
about going forward? Starting with S&Ps. I know I talked to you the other day, and we both took a shot at the short side during this reversal day. And one of the reasons is you didn't have breadth confirming on this last run up here. How about now with this rally to new highs? Where do you sit, and what are you thinking and considering going into next week with the S&P?
Okay, so the advanced decline line is a great technical indicator. Is probably the longest technical indicator in existence. It goes back, I think, either the late 50s, early 60s. Prior to tops, whether they be an intermediate top where the market's going to drop 5 to 10%, or a major top, the advanced decline line will often fail, as you discuss often about various technical indicators.
Right.
So last November, the AD line made a new high. So in February, as the S&P was making a new high, the AD line was comfortably below where it was last November. And to me, that meant we were set up for a decline. I thought Trump was serious about the tariffs, and the narrative was, he's just going to, he'll cave in quickly. And that was even before the taco phrase came up. And I didn't think that was the case. And so to me, that set up a decent sized decline, which of course we saw. Since mid-May, the AD line's been making higher highs above where it was in November. And that's why I've been bullish, thinking that we're going to go up more. I also have an indicator that looks at the breadth every single day, advances minus declines, and then using a 21-day moving average, because it kind of measures thrust to the upside and downside.
Okay.
So we made a new high yesterday. Both the 80 line and this thrust indicator, Dale, are comfortably below where they were. So even though we had a little sideways thing, over the last week, breadth underneath the surface was far weaker. So my take here is, and the RSI is diverging. So,
It is.
So to me, we're set up for a pullback of maybe 3 to 5%. And the other concept that has to be understood, I think, and technicians don't always filter this in, the stock market is long biased. All right. Institutions, pension funds, financial advisors, buy and hold, buy and hold. All right. So for institutions to back away from the market, they need a really good reason to sell.
Jim says this to me every time I bring up a bearish technical argument, he always says, Dale, they need a reason to sell. There's no reason to sell. I go, yeah, but look at this divergence and the key reversal and the triangle. Dale, they need a reason to sell. So, can you see any reasons coming up? And are there any levels in the S&Ps since we have the AD line and the
Yeah.
other indicator not confirming that you might be considering probing
Well,
a
the two
short?
reasons, Dale, are treasury yields, because I think the
Okay.
longer term trend in yields are up. I think it's just
Yeah.
a question of when the 30-year gets above 515, which was a high a few weeks ago, as well as October of 2023. So that's one problem for the stock market. The other thing, we have tariffs coming up again on August 1st.
Yeah.
The Fed, the messaging from the Fed is not going to change in terms of we're going to stay patient until either the labor market weakens and we buy time to see what the tariffs are going to do. So I think 59.50 down to 58.50 are two reasonable targets. Unless we see treasury yields break out, my expectation is we're going to see a modest pullback before we see another move to a higher high.
Okay. From here, Jim, or is there maybe another 40, 50 handles to the upside, or is that hard to call?
That for me, it's hard to call. We've satisfied the minimum. We made a new
Okay.
high. Can it carry through a little bit? But my point is sentiment. Okay, I mentioned the three products. Sentiment. So bullish sentiment is very, very high. And so that tells me that the next bigger move is more likely to the downside. Now that some of the technical stuff is confirming that, it makes me believe that, okay, you might have a 1% move to the upside, but we're talking 3 to 5%, possibly worse, to the downside. So any price reversal that takes place now with all this in place, to me, is the signal to go short. One of the things I like to look at is the 5 exponential, 13 exponential. You can do it on any time frame you want. I use a lot a 2 hour as well as 30 minutes to look at. So what this setup says is that, all right, you get a price reversal in the 5 and 13 cross. That's a good place to look to go short.
And you would also you came out of the short early this week because you identified it as a three-wave decline, a corrective zigzag.
Yep,
So
it was an
would you
irregular
wait?
ABC. You had a
Yeah,
drop.
yeah,
The S&P went to a modest new high, I think at 6302, and
yeah,
then on the Powell news, we took that out. And
yeah.
so it's like, okay, without the follow through. Plus, bullish sentiment means that people are looking to buy any dip.
Any
And
dip.
so again, it goes back to that reason to sell.
Okay. So would you wait for a five-wave decline, like on an hourly basis, and then try and sell the next rally, or are you going to just take a position on a reversal day, or
I think
or
you
even?
can do both in terms of saying, all right, you get a reversal day, 5 and 13 cross, you put something on, you get 5 waves down, wait for that bounce to add to the position. All those are key inputs in terms of, all right, when is the market likely to pull back? Key level, again, I think would be a close below 6206.
Okay,
All right, we spiked
62.
below that
Right,
obviously on the Powell
right,
news, but
right.
a close below that level now, I think would actually be pretty meaningful.
Yeah, we have some moving averages there. All right, let's move to what our bailiwick is here, and your take on the dollar, Jim. So,
Okay,
all right, here we
so
are. Here
yep.
we are.
All
Go
right,
ahead.
so again, bigger picture. Sentiment and positioning is more extreme against the dollar now than any time in the last 20 years. So people are either short the dollar, long other currencies. So that suggests to me that we're near probably a decent trading low. In addition, if you go back to the high in October of 20 or September of 22, when the
Right
dollar
here.
traded above 114,
Yeah,
you can see a big A, B, C, A down to about 99 and a half, B
yeah,
up to the 110 in January. That was why I turned negative the dollar back then. I thought we
right.
would see it trade under 100 and maybe approach 95. It got to 96, I think 34. So you've got sentiment and positioning suggesting that we're nearing what's going to be, I think, a meaningful trading low. The chart pattern longer term says we're near a low. what we've seen is the dollar made a lower low in the last couple of weeks. The RSI diverged significantly, 31 versus 21 in April. The 5 and 13 have crossed. There's a downtrend line from the high of 101.97 that the dollar has just broken above in the last couple of days. So to me, more and more evidence is accumulating that the dollar is in the process of bottoming. I think a rally to 105, 106 is a minimum. And if we see a clear 5-wave up off this low, recent low, then the odds are, then we can measure some stuff and say, all right, is it getting up to 110? So again, to me, sentiment and positioning can be very helpful to define some of your risk, and look at the narrative that you talked about earlier. I've seen more articles about the dollar's status as a reserve currency being at risk in the last 4 to 6 weeks than I have in the prior 4 to 6 years. So that's the kind of sentiment. And as I said, positioning in the markets is extreme, the most extreme in the last 20 years.
Is there a case, Jim,
it's
that
just looking for entry points for the long side?
All right. Is there a case that this could be a 4 and we still have a 5 to take out 96 and get to that low around 95? I'm talking my book right now.
Yeah. No, that can't be ruled out, Dale. But I mean, people who are looking for, 88 or all that stuff, I just think are misplaced.
Okay. Let's go to gold because I know you're looking for new highs, but I think you're looking for new highs from lower levels.
So when gold traded up to 34.96, the positioning sentiment was crazy bullish. I thought we'd have a pullback. It quickly dropped to 31.27. Then it ran up to 34.49, that high back in June. And so for me, Dale, there's 2 counts here. Well, maybe 3. And that's the thing with Elliott Wave. It's helpful about 1/3 of the time. And 1/3 of the time you got more than one choice. And 1/3 of the time it's gibberish. Either we're in what I think is wave 4 from that 34.96 high. It's either going to be an ABC down where you take out 31.27. I think more likely is we're going to drop below the recent low at 32.50, whatever it was.
Yes.
But hold above 31.27. So you have 3 down for an A. The rally up to 34.49 is a B.
I see.
And I think we're going to see a C wave that undercuts that. And in a triangle, the moves are all 3s. All right. So it's choppy. And as we can see, it's been extremely choppy. And if it's a triangle, this choppiness is going to extend for another number of months because you need a wave D pop, wave E. But again, the triangle means that the lines should be coming closer and closer together. When all this is over, I think gold is going to rally above 34.96 in wave 5.
Got it.
So it's just
that'll be it. That'll be it for a while.
Yeah. So we're just looking for a place where, the RSI, if it does drop below that 32.50 something, the RSI will get closer to 30. There you have then, I think, a decent entry point for a choppy trade to the upside.
Okay. I want to wrap it with TLT, Jim. I know that, from certain levels, because you are looking for a slowdown to come. You were months ago saying that we're going to have a slowdown. So that built the fundamental case for bonds, and you've tried it and you had some success, but you changed your mind when the rally got up to here and it was weaker than you thought it should have been, that you were looking for better levels. Now it looks like we're going to attack the Moody's low, downgrade low. You have targets on the downside for TLT?
Well, I think
will there ever be a time that the bonds, when people throw up their hands, where the bonds will be a great buy?
Well, the problem is now we're dealing with supply of treasury paper, Dale. So normally a recession or market slowdown in the economy, the institutional reaction is, well, let's buy bonds, because the Fed's going to be cutting rates. Complicating that now is we're running a 2% a $2 trillion deficit with GDP growing at 2.5%. That's never, ever happened in our history. All right. So if we have a recession, the deficit will go up to 3 trillion. That's a lot of paper. All right.
So the worst of both worlds, a recession with high rates.
Yes. And I believe if you look at a longer term,
that's a
one
nightmare.
of the things I've been talking about is a secular bear market in treasury bonds. So
Right.
if you go back to the 1940s, you saw a move from I think it was about 1.25 in the 10-year up to 15.5 in 1981, from 46 to 81. And then from 81 to 2020, a huge secular bull market. But the decline from that high in 2020 in terms of treasury bond prices is clearly five waves. So
Okay.
to me, and you broke a long-term trend line going back to 1981. So all those things really, I think, suggest you got to be careful that we're entering and have entered a new secular bear market. And I thought in October of 23, I thought bonds were going to rally. TLT went from what, 82 and change to
Right.
100-ish.
Yeah, right here.
You know, I thought there would be, you know, this is months and months ago, another pop that would be, you know, an ABC type of thing.
Take
And
it up to
then
here.
when we
Yeah.
got up to, I can't remember what the price level, there was a
100.
five-wave decline if you look at like, you know, hourly stuff and so forth, which kind of said, guess what? The rebound is over. And so I believe that supply is going to be an issue. And Besant is coming up, I think, at the end of July with the Treasury. You know, what are they going to do for the next quarter in terms of issuance? What'll be interesting, Dale, to see if he tries to manipulate the curve by increasing T-bills from 22% of the total to, let's say, to 25, and then reducing the long-term stuff from around 17% down to something less than that. So that, oh, more issuance short-term, less long-term issuance as being a way to try to get the 10-year to come down. We'll see if he does, that will kind of reflect their concern about what's been happening with the 10-year.
Okay. And you have a pretty aggressive target to the upside in the 10-year. You want to share it?
Yeah, I mean, so again, you know, the high in 81 was 15.5. The low is about 55 basis points, so call it 15 points. If we do a 50% retracement of a 15% move, that's 7.5 added to the
Wow.
55 basis points. So, you know, I've been saying 7.5 is the target for the 10-year, whether it's 3 years from now, 5 years from now. That part can't be determined, right, as we sit
Right.
today.
Yeah.
But from a bigger picture standpoint, I think, uh, again, if we're in a secular bear market, that is a, you know, somewhat conservative upside target.
Yeah. You know, Jim, this does look like consolidation after a straight line move, some type of flag, triangle that almost invites an upside breakout because of the trend.
Yeah, yeah. I mean, you know, again, you watch how markets trade in reaction to historical norms. Fed cut the funds rate 100 basis points, and 10-year went up 80 to 100 basis points. It's like, whoa, that's never, as you pointed out, you don't remember that happening. Why? Because it never happened before. So, you know, these are the types of subtle, if you will, hints that something's different going on here. And I think, you know, unfortunately, the level of divisiveness in our country and politically means that both parties, they can never compromise and agree to accomplish anything. So, you know, just as an aside, and people don't take this wrong, I'm just a numbers guy. But, you know, what's happening with Medicaid, pardon me, is that spending on Medicaid is going to go up 2% a year for the next decade. It was projected based on the baseline. In other words, what they projected to do was 4%. But it's going to go up 2% a year over the next decade. And yet, the way they talk about things in Washington, D.C. is, oh, they're cutting they're going to cut Medicaid. They've never had such a big cut. And so most people hear that and say, well, gee, that doesn't seem right. They're cutting Medicaid. And they're not cutting Medicaid.
They're
Spending
slowing
is
the
going
spending.
up. It's just going up less than what they wanted it to. So, you know, when you and I decide we're going to spend less money on something, last year we spent $1,000 on something. Well, I'm going to spend less money. Okay, we spend 950. In Washington, it means they're going to spend 1,020 instead of 1,040, and then call that a cut.
Right.
So my point is, and of course, President Trump, you know, occasionally the truth and his comments intersect, and so forth. So we have it on both sides. And I think for most people, we just don't know what to believe because both parties are willing to say whatever they think they need to say to score political points. And that's not the kind of environment where you can come together. And so my concern here, Dale, and I think you share it, is that we're headed for a difficult period. I think we're going to see another secular bear market in stocks like the 1966, the 1982 period, the 2000 to 2009 period, where stocks just don't keep going up. And in fact, they go sideways to down.
So
And
we
most
get
people
we
aren't
get an
positioned for
L.
that.
Yeah, we get an L. No more V's. We get an L, letter
Yeah.
L. Yeah.
Yeah. I mean, folks, look up a chart. You can do it on the Dow easily from 1966 to 82. The
Yeah.
Dow hit 1,000 in 1966, and in 1982, it was 800.
Yeah.
But you had enormous declines and rallies. So it was a trading environment, not a buy and hold environment. But most of the world is buy and hold because you can never time the market, so they say.
Yeah.
So
You don't
I
believe
just think
that.
the world has changed, is already have changed, and now we're going to see evidence of it. And the other thing I'll point out is yields are going up around the world long on the long end. And so it's not just the treasury yields doing this. And Europe is going to be spending a lot more money. They're going to be borrowing more money because they're going to allow greater deficits for military spending, infrastructure spending, and so forth. So we have a global thing that's going on here that I don't think a lot of people understand and realize, and how it's going to play out, I think, in the next, 3 to 5 years or longer.
Okay, Jim, I tell you what, it was so great to hang out with you for 40 minutes. Feels like it's been 40 years since we've done this. So,
Well, I guess we're in the desert, huh?
yeah, well, we all have to take our own exodus. So, again, here's Jim's website, macrotides.com, where you could write Jim and say you saw him here on Face and you want to take him up on his offer to read his stuff. He has a couple of different things depending upon your cup of tea. He has a real long-term stuff, the monthly global economic reports, and I read his stuff. I think that you guys should include him in your intelligence gathering because you just heard 40 minutes of intelligence, and that's not enough to carry you forward into the kind of environment we're going to be in for the rest of the year.
Well,
So,
Dale, thank you for your kind words. I appreciate that, generous. And I can tell you that I never heard that from any of my teachers.
all right, well, my trading warrior brother, Jim Welsh, that's why he's on uh, Blake's channel over there, because I would send Jim and the team Jim's market letter. So Blake thought enough of his work to make him a regular every week on Trader Summit. So, guys, that's going to be a wrap. Thank you, Jim, for your time and your insights and edifying our community today. It was great hanging out with you, bro.
Hey, thank you, Dale, and back at you. And obviously, I'm pretty sure your community already knows the talent and intelligence that you bring to the markets in all the things that you're doing. And I think your audience obviously has benefited from that over time. So they're lucky to have you as well, Dale.
All right, what a great bromance wrap up a Friday. I'm feeling the love, and guys, the team loves you guys, and that's why we work hard for you not to blow up and to have a measure of success. And Jim's like that too. He cares about his clients. So that's a wrap. Remember, don't just count your pips, count your blessings. And we'll see you on Monday, God willing, and do it all over again. Aren't we lucky?
We are.
All right. You're welcome, everyone. Thanks, Jim. And that's a wrap. You could join the team in 1 minute on the Morning Edge. See everyone Monday. Thanks again, my good friend, Jim
All
Welsh.
right, Dale. Thank you.
See you guys. Adios.